Alright guys, so on the previous video I told you I'd be learning about liquidity, right? I was watching the Trading Geek, right? I did learn somewhat, but I wasn't learning everything like step-by-step process. So I switched over to the a different YouTube video, which the name is the Mind Math Money, where this guy, he was like 1 hour and 33 minutes long. He explained every single thing about liquidity, and I believe I understand most of it, not everything, but I'm still regrouping, still learning. So I'm gonna be showing you guys everything I learned from the Trading Geek, and then I'm gonna be showing you everything I learned from the Mind Map Money YouTube channel guy. Alright, so this is what I learned. So liquidity is how liquid the market is at a very point. Liquidity is a resting order. Liquidity is the fuel they need to move the price. Where do you spot liquidity? You can spot liquidity above or below support and resistance level. Right? I already learned about support and resistance levels, so I know where those levels are. Above a swing high or below a swing low, and I already learned about higher high, lower low, and stuff like that, so I know exactly where to find liquidity. Third is equal highs / equal lows. We also learn about timing, and this timing is not like just thinking about, oh, when I wake in the morning I'm gonna look at the chart, or in the evening when I have time. No, this time allows you to figure out when this institutional flow of money is going to come in the market, when you are able to enter at a perfect time right before the lot move. And these timings is basically when the market opens and closes. You have to learn those stuff. So two windows of opportunity: London open, New York open. These are the kill zones. So we have the London open 3 to 6 Eastern time, liquidity enters. London, New York overlap 8 to 11 Eastern, highest volume of the day, so this would be like the best time to trade. We have the New York session 8 to 1700 Eastern, expansion of our reversal, so those are the best time to trade. And simple steps to combine liquidity and timing: you have to identify the trend and direction and structure. So you identify the higher low, or the lower low, or the higher high and the higher low. You have to identify the breakup structure, where the liquidity sits. So you have to learn that this is a downtrend, so stuff like that. Two, identify where liquidity sits, as I told you. Three is wait for active session. So wait for active, like time when the market opens, so London open or the New York open. Let price sweep available liquidity. Wait for a reaction. Execute with defined risk. So first thing, identify the structure of the market, so where the market is going. Look out for liquidity sits, the actives. Wait for the market to open. Wait for the market to sweep first. Wait for a reaction, and then you go ahead with a defined risk. So that's everything I learned from the Trading Geek, and then over here is what I learned from the mind math money. Guys, so you saw everything I learned from the Trading Geek. That's everything. I believe those information are pretty useful. Like I wrote down the useful information. But moving on to the mind math money, this is where a chunk of most of the information is at, where it gets deep. So we're gonna dive into that. This video might be a little bit long. I'll try my best to edit it out and provide you guys with a quality video. I'm just starting out on this YouTube and trading. So guys, once you see this video, always try to like, share, and subscribe. Alright guys, so now moving on to the mind math money lesson that I learned. So liquidity means how easy it is to buy or sell something quickly without moving price. For example, a busy farmer's market versus an empty antique shop. So the busy farmer's market will have high liquidity, and the empty antique shop that just have a buyer and a seller will have low liquidity, right? The more buyers and sellers there are at every price, the more liquidity, and the smoother the price moves. High liquidity, price moves smoothly. Low liquidity, the price moves in chunk, right? The most traders are the liquidity that smart money uses to fill their trades. So like small traders like myself, or other persons that are trading, small people, the smart money like the trust funds, the banks, use us as the liquidity sweep. right? So there's three types of orders. We have the market order where trade immediately. We trade immediately at the best available price, right? So for example, price is at 100, we're just gonna trade at 100, right? There's no win or lose situation to trade at the best price. Limit order, trade at a better price than the current. So we'll buy below and we sell above. So for example, if the price is at 100, we're gonna buy when the price is at like 95. So we buy it low and we sell high. So price at 100, wait till price get to 105, then we sell. So we get more for our money. That's basically what I understand. Then we move to the stop order. Trade at a worse price than the current. So that's like buy above, sell below, right? So for example, if the market was at 100, right, we're gonna buy above, right? But the intention is not to buy above, but that's what happened. The market moved to 105 and we end up buying at 105. Or the market was at 100 and it moves to 95 and we end up selling at 95, so we get less for our money, right? If that's not what this means, someone can just explain into the comment section for me. As I tell you, this is a learning process. I'm just learning trading. Moving on. All right. So this is a note. Your stop loss in a long trade is a sell stop. Your take profit is a sell limit. Short trades flip both. All right. So in a stop, so your stop loss in a long trade, that's when you're buying, right? And so your stop loss will be below. Stop loss is basically the area that you decide that you don't want to lose any more money if you're actually gonna lose the trade. So you just put your stop loss here, saying that if the market should hit here and go below, you don't want to lose anything below this level, right? And the opposite, if it's a short trade, stop loss will be up here. The rest of the sell limit will be down here. So if the market should shoot up, we know that if it goes to above this level, then it will just stop because you don't want to lose anything more above that level. I also learned about the buy side and sell side liquidity, right? So learn about buy side and sell side liquidity. Abbreviation is BSL and SSL. So the buy side liquidity is the cluster of buy stop orders above a swing high, right? Stop losses from shorts plus breakout entries from longs. What I understand from that is say we have swing highs, right? Swing highs. So this is a swing high right here, right? We're gonna have the cluster up here. That's where everybody is at. Everybody that's buying or selling and whatever. So we're gonna have a lot of buy stop orders. We're gonna have a lot of buy stop orders at this level, at the swing high, right? Plus the breakout entry traders from longs that are the breakout people that think the market's gonna continue up, right? So that's the buy side liquidity. Sell side liquidity would just basically mean the opposite. So clusters of sell stop orders below a swing low, stop losses from longs, and breakout entries from shorts, right? This is an example right here. So we have the swing high. So the market is going in an uptrend, right? So let me just do this. So this is where the market is coming from. So this was a high and then it swing higher. So this is the new swing high, right? So we're gonna have a buy sell. We're gonna have a buy side liquidity right here. We have the buy stops here. And this is the cluster. This is where most persons is at. Down here now we have the sell side liquidity, the sell stop. So you can see that as an example. Alright, note smart money targets these levels because triggering them creates a wave of forced market orders which provides the fill they need. So basically, smart money is the big banks, trust funds, index. They love those big units, love those areas because right there they basically are able to manipulate the market into the direction they want to push the market. So if there's a lot of buy stops in the market, they might just reverse the market into their direction so they can fulfill their market orders. Hopefully that makes sense. Liquidity sweep. So liquidity sweep, price slowly breaks a swing high or low, chops breakout traders, then reverses sharply. Slow deceptive chop. So for example, so the market is coming from here, swing high, then swing higher. So this is a swing high right here, right? And then we have the breakout traders right here as well. So you notice the market went up to this level, then it pushed back down to here. So this is a liquidity level right here. And then the market just reversed to the downside. So it slowly breaks a swing high. So you notice it break a swing high right here, push up, traps breakout trader right here, then reverse sharply to the downside. Hope everybody is understanding that. Liquidity grab, a fast wick that pokes through a level immediately rejects the obvious manipulation move. So a liquidity grab pretty much similar to a liquidity sweep. Liquidity grab is just faster than the liquidity sweep. So liquidity grab way faster, liquidity sweep moves slower. For example, so liquidity level right here, we get a long wick because we're gonna trap the breakout traders, the smart money, we're gonna trap the breakout trader. So we have a long wick right here, push back down, and then immediately rejects to the downside. So it's a faster move, so it just go up here and rejects all. This one is a little bit slower. Up here is a little bit slow. And then we have the liquidity run. Prices takes the level and keeps going. This is a real breakout, not a trap. So the liquidity sweep and liquidity run is a trap because there is a reverse in the market. But the liquidity run, it has a breakout, but it just continues straight up or it continues straight down. So for example, market starts here, push up, and we get a big candle right here, and then it continues to the upside. The breakout continues. White matters, sweep and grab give you a reversal trade, run tells you the trend is real, trend is continuing. I also learn about external versus internal liquidity inducement. So external liquidity rests outside the current range. So buy side liquidity above the major high, sell side liquidity below the major low. That's an external liquidity. External liquidity, in my own words, is just basically the most obvious parts on the chart. So once you can identify the highs and the lows on the market, the most obvious highs, most obvious low, that's the external liquidity rests. So it rests outside the current range. Buy side liquidity above the major highs, sell side liquidity below the major lows. So the internal liquidity sits inside the range, minus swing points, pullback highs or lows, fair value gaps. So for example, so we have this major swing high right here. So this is the external liquidity. Easy to identify because this is the highest point, the highest high. So this is a buy side liquidity. The most obvious low, this is the lowest part on the chart. So this is the external and it's the sell side liquidity. Internal is inside here, internal liquidity, all these internal, right? Then we have the liquidity inducement, a deliberate move against the trend that sweeps internal liquidity to trick traders into the wrong side, then continues in the original trend. So, for example, we're moving in an uptrend, right? So high, new high, right? New high, and then the market push down to this level, then it rejects, push down again, then it goes up to the upside, right? So right here chops the reverse. This is an internal liquidity right here, and then it just push up to the upside. So that is a liquidity inducement. Pro tip: internal liquidity tends to get taken first, then external. This sequence is one of the cleanest setup in a price action. Alright, so now we have high resistance versus low resistance liquidity. Low resistance liquidity forms after a failure swing. Prices try to make a new high or low and fails. That side hasn't been fully tested, so I'm going to show you guys that. So look at this example here. So LR equal failure swings, so low resistance failure swings. So market swing high right here, right? And then market should have swing high again, because this is the buy side liquidity. So with buy side liquidity is we're swinging high and swinging high. So it's swing high, and then it should have swing high again right here, but it failed. Failure swing. So right here is the buy side liquidity above lower high, because it didn't swing higher than this high. So this is a low resistance liquidity. And then here, this is for the buy side liquidity. Then here for the low resistance sell side liquidity will be the opposite. So swing low right here. This should have swing lower, but it didn't. It failed, and it swing right here. So this is the failure swing high. This is the failure swing low, I should say. So higher swing low, below, and then we have the sell side liquidity below, higher low. Hope everyone got that. Alright, so we're moving on to the high resistance liquidity. Alright, these forms after a clean break, a higher high followed by a lower low, or vice versa. That side has already been tested. So we have the high resistance buy side liquidity. I'm gonna show you that. So this is a high. So we expect it's a high resistance. So we expect it for swing high. We expect it for go exactly how we want it to go. So it's swing high, then it's swing high again. So we have the high right here, and then as it says, forms a clean break and a higher high followed by a lower low. So this is even. So right here we have the lower low, and then we have the higher low right here, and then we have the lower high right here. Sweep first right here. This is a buy side above higher high, and then now we have the high resistance sell side liquidity, which is just the opposite. So we have so we swing. This is the lower high, then we swing to the lower low, and then we swing, then we push up to the high high, and then we have the higher low right here, then the sweep first right here, and here down here we have the sell side liquidity below the lower low. Right? The idea, once high resistance liquidity is taken, price tends to travel toward lower resistance liquidity, the part of less proven defense. For example, so we're going in an uptrend, right? Uptrend. We have the high resistance buy side liquidity here. This is one here. This is one here. And here we have the low resistance sell side liquidity right here and right here. This might look a little bit tricky, but if we just cover right here, we notice this is a low, and this low didn't swing lower than this low. So that's the reason why this is a low resistance sell side liquidity. And then we have this side here, the high pushing down, because as it told you, it tell you that once high resistance liquidity is taken, price tends to travel toward the low resistance liquidity. So seeing that this was an uptrend and the low resistance liquidity is here, so price tend to travel down. So you know, it travel to here, pause here, travel to here, and continuing down. Moving on to equal highs, equal lows, and trend line liquidity. As we told you, liquidity can lie in equal highs, equal lows, trend line liquidity. So equal highs, equal lows, multiple swing points stacked at the same price create a deeper liquidity pool, more stop cluster, more fuel for sweep. So for example, we have the high right here, one high, second high, third high, fourth high. But we're focusing on these three highs. So price push up here, push up to here, push up to here, right? So we have a stacked price, a lot of prices here, a lot of buyers or sellers or whatever up here, right? So this create more stop clusters, which will fuel for the sweep. And we have equal lows. Equal lows can be the same thing, but this is just a market. This is just showing the equal highs here, clusters up here. Then you notice right here we get the sweep on the fourth time it comes to this level. So look at this, you see the wick, long wick right here, and then it push down rapidly. So this causes the sweep. Trend line liquidity stops also pile up below rising trend lines and above falling ones because traders place stops where their pattern would fail. A simple example of a trend line. So this is a trend line right here. You know, price is touching here, touching here, touching here. So we can have liquidity on a trend line. So we can expect price to come and touch here and then should push down rapidly, or it can just reverse and push up rapidly. So we can expect some changes right here instead of it looking just like these three. As I said, I'm just learning this, so everything I'm saying might not be 100% correct, but this is what I learned so far. I'm just starting out, so maybe in the future I'll understand the concepts better and be able to know exactly where I went wrong in these previous videos. So the lesson: any tool that produces predictable behavior creates predictable liquidity. Chart patterns, Bollinger Bands, moving averages all work the same way. So I'm not really sure about these. I haven't learned these as yet, but I just wrote them down. Warning sign: the cleaner the trend line, the more likely it gets swept before continuation. So we're moving on to fair value gap. So fair value gap, what we do to identify this is basically a 3-candle pattern where the high of the candle 1 and the low of the candle 3 don't overlap, leaving a price gap that wasn't fully traded through in the second candle. So this is like a 3-candle dimension, so I'm gonna show you. So we have C1 candle, so candle 1 here, this is the high of candle 1. I just drawed some dotted lines. This is candle 2, it's a big candle here, candle 3, so see candle 3 low right here. Notice the wick of this candle is not overlapping with the wick, or the body is not overlapping with the body. So that's the reason why it forms this big candle here. So right here has the fair value gap. This is where the gap is, fair value gap. Here we have liquidity void. Any area where price moved fast with little resistance. Fair value gaps are the most common type. So liquidity, a fair value gap is considered as a liquidity void. For example, we have a candle right here, and then there's no trades happening here. So this is a liquidity void. Then trades began here again, right? So gap is open, no trade happening here. This is a liquidity void, and most times price will return to this gap. So this gap right here, price will come down to fill this gap, and then continue to do what you want to do after that. Then it returns. So why price returns, the market often reaches the gap before continuing. Fair value gaps are a clean reaction zone, especially when they align with structure or higher time frame levels. Stronger gap. The same idea but stronger, where price physically jumps over a range. Common in stocks at market open. Rare in 24/7 markets. 24/7 market always moving, so you're gonna have less gap in those markets. So order flow tools, we have volume profile, footprint, and VWAP. To be honest, the video that I watched didn't go in full details of this, right? But I know there's other videos I can watch about this. But this is just what I wrote down about it. So I still haven't understand everything about it, but I wrote down this information. So I'm just gonna go through this section real quick. So volume profile shows how much volume traded at each price level. High volume nodes equal history, liquidity history. Low volume nodes equal liquidity voids. Then footprint chart shows buying versus selling aggression inside each candle. Imbalances reveal hidden support and resistance. VWAP, that's volume weighted average price. The days centered of mass of executed liquidity. Anchor VWAP brain channels tool lets you anchor it to any major event for dynamic support and resistance. These tools show the history of liquidity. Now we're gonna go into this slide. This information will show the persistence of liquidity. As I told you guys, I'm not fully aware, I haven't fully understand this section here yet. Getting there. So the liquidity heat map shows where limit orders stayed long enough to matter, not just where they briefly appeared. It filters out spoofing and fake orders that get cancelled, leaving only the levels with real intent. Bright zones equal persistent resting liquidity. Dark zones equal no real interest. The rule: when price hits a bright zone and stalls, absorption is winning. When price zooms through a bright zone, aggression is winning. Now the heat map patterns: walls, clouds, withdrawals, and flips. Liquidity wall: a single price level with persistent resting liquidity appears as a bright horizontal line. Stacked walls / liquidity cloud: multiple levels of resting liquidity grouped together. The thicker the cloud, the stronger the absorption zone. Liquidity withdrawal: the wall disappears, path of least resistance opens, price often runs through the level fast. Liquidity flip: a wall gets broken but price still reacts at the level. Later the market remembers where aggression won. And guys, that's everything I learned about liquidity so far. You let me know if there's more to be learned about liquidity. You let me know if there's any area in this video I went wrong. Give me any advice you guys can give me about trading and learning the concept of everything related to trading, trying to become profitable in trading. So you guys leave your tips, leave any criticism in the comment section. I will look at it. And I did learn supply and demand afterwards, so I'll make another video about supply and demand and everything that I learned so far. Alright people, so remember to like, share, subscribe to my channel. Leave your thoughts in the comment section, leave your advice, your tips, your criticism, everything. Leave it in the comment section. Stay tuned for more. I'll be showing you everything I learn about supply and demand. I'm out.